In the last few months, we've seen countries reopening their economies and restrictions linked to the COVID-19 pandemic being lifted. GDP growth projections keep being upgraded. The United States in particular continue to surprise to the upside. In the latest update of their World Economic Outlook in July, the IMF forecasted 7% GDP growth in 2021, a level that was last reached in 1984. In this context, the question of inflation has been the main topic on the mind of fixed income investors over the last few months. Within developed economies, it is again the United States that has seen the highest inflation numbers, with the consumer price index reaching an impressive 5.4% in June, a level that had not been reached for more than a decade. At this point, it is still possible to argue that the high inflation print is the result of temporary factors, which remain the base case of the Fed. Indeed, most of the increase in inflation to date can be explained by base effects or by disruptions linked to the pandemic. Most notably, the shortage in semiconductors impacted car producers and resulted in a 30% increase in the price of used cars and trucks over 1 year, explaining a large amount of the increase in the final inflation number. However, there is a real risk inflation in the US could remain more elevated than anticipated. As the government provided extraordinary assistance during the pandemic and spending was constrained by restrictions on activity, households accumulated large excess savings. The spending of those savings and pent-up demand is now resulting in a very large surge in consumption, leading companies to increase their prices and their own inflation expectations. While unemployment remains higher than before the pandemic, several measures of the health of the job market, such as the number of hard-to-fill jobs and the number of employees voluntarily quitting their jobs, are the highest level they've been. This could result in upwards pressure on wages, which is one of the most important factors impacting long-term inflation expectations. In addition, the highly stimulative nature of the pro-growth policy of the Biden administration could also fuel more persistent inflation. Whatever your views on this topic, the latest development in the US Treasury markets have probably been the most surprising. If you had conducted a few years ago a survey of investors asking them at what level they saw 10-year US Treasury yields would be if GDP growth was at 7% and inflation over 5%, I don't think many would have answered correctly. Indeed, after reaching a high of 1.7% at the end of March, 10-year US Treasury yields dropped again below 1.2% in early August, entirely dismissing these recent and surprisingly high inflation prints. This results in historically low and deeply negative real yields, the yields adjusted for inflation, and this is one of the reasons why the balance of risk in the US sovereign bond market is skewed to the downside in our view. On the other hand, we think the current environment of strong growth and accommodative monetary policy is positive for corporate bonds. While credit spreads have come back after the widening of early 2020 and are tied by historical standards, we believe they do offer adequate compensation for the risk of default, which should remain low in our view. In this environment, short-dated credit, which exhibits low interest rate risk, can be an interesting option to access credit in a relatively defensive way. Another area of the market where we think opportunities can be found is emerging market debt. The rebound in growth has been uneven across emerging markets, and the impact of the virus is tragically expected to be felt for longer than in developed markets, and the availability of vaccine is still too low. However, the very strong rebound in commodity prices over the last 12 months has been broadly supportive, and we do not expect inflation to become unmoored in the end. While the Fed is not expected to hike before 2023, several EM central banks have already started hiking rates, for instance in Russia, Brazil and Mexico. This results in more attractive yields and should be supportive for their currencies. Indeed, many emerging market bonds provide local currency real yields above 3 or 4%, which we believe is attractive in a world of deeply negative real yields in developed markets. EM currencies remain broadly undervalued in our view and could provide upside in the medium term. High-yield sovereign bonds in the hard currency EM market is one of the few asset classes where credit spreads remain more elevated than before the pandemic, and they still provide attractive value in our view. Finally, we think that EM companies' fundamentals have improved materially over the last 12 months, with net leverage coming down significantly. Of course, risk remained in emerging markets, which is why we believe in the importance of an active approach, putting a strong emphasis on diversification and selectivity. Thank you for watching.